Hey, Rosario, how are you?
Okay, Professor, how are you today?
All right. Good evening, everyone. Okay. I'm good, my dear. Thank you. Thank you. Good evening, Stephen. How are you? Good. Hanging in there. Lou. Now, as I understand it, we have a break coming up soon. Hi, Krishna. We have a break coming up soon, right, class? Not a month from now. No, it's a couple of weeks. All right. So, no, beginning of March.
Professor, the break that we have is going to be the end of March when Passover begins, March 27th.
The 27th.
Yeah, March 27 to 4th of April,
It's
yes.
it's supposed to be the start of spring break.
Um, Hold on one second. I don't know. I thought I saw something else. Okay, you guys are right. You guys are right. Okay. Okay. No, someone told me differently in the other class. All right, that's right. Um, we're gonna start soon. Yeah, it's a month from now. Okay, thank you.
So, Professor, do you know like tentatively what would be our a final exam date in May?
Hold on, I can tell you that. May 25th.
Okay. Thank
All
you.
right? Okay. Okay. A couple of minutes. Yeah, it's a little early because then the weather's bad. I just want to give everybody a little chance to come in. All right. I'm gonna go over the quiz, and then we're gonna start on chapter 3. Okay, let me go over the quiz, and we'll start on chapter 3. What? We'll talk later about that. Let me get started. Okay, can everybody see this?
Yes.
Yes.
Okay, so we know everything here. We know that the market capitalization, right? The number of shares, outstanding shares times the price. The market to book ratio is the book value versus the book value versus the market capitalization. This is saying that the market value is almost three times. We're comparing debt to equity. We know it's 2.07, right? And we're comparing market debt to equity ratio. We know it's 0.71, right? You have all those things there. And then we know that the enterprise value is market shares outstanding plus debt minus cash. Now, if I was someone who is a betting person, I would remember all of these formulas, write them down, and go over them. Practice them when you have a chance here and there, and you'll be able to do this if this is one of the questions on the exam, right? Yes,
So for the enterprise value, the first thing in the equation is market capitalization.
that's right. That's right. That's right. Plus debt minus cash.
Got it. Thank you.
Okay. Now, remember we were talking about this, and I told you the reason why it was a negative number. They borrowed, and the negative number not only took this number but left the balance. If you add this as an absolute number and this together, it will give you 2,108, 2,001,008 as a negative, because a negative number, right, on top of this leaves you a negative balance. It took over this number and it left you with a negative balance. Now, we've gone over this while we were doing the homework, and I wanted you to understand this. right? Because it says right here, is the company market to book ratio meaningful? It is book to debt meaningful, right? Because the book value of equity is negative in this case, the company's market book ratio and book debt equity are not meaningful. And also because the book value of equity is negative in this case, the company market equity, market debt equity ratio must not be used in comparison, right? A lot of times you can have a company that borrows a lot, that happens a lot, right? But that does not mean that they are bad in performance. That does not mean you can use that to measure the company's strength or reliabilities in those things. That's not an issue, right? As long as they pay back on time, as long as their debt, there's no, like, they're not in judgment or anything, right? It's like a person. You can have somebody that owes a lot of people, but they're able to pay. So it's okay. As a matter of fact, they have a great credit rating. That's the same way you have to look at a company, right? Information from the statement cash flow explain that the decrease of book value of equity resulted from an increase in debt that was used to repurchase 2.18 of the firm's shares. That happens a lot too. Firm reinvests in itself. And then does the company book value of equity 20 imply that it's unprofitable? If a firm borrows to repurchase share or invest in intangible asset, it can have a negative book value of equity. And negative book value equity does not necessarily mean the firm is unprofitable. 100%, right? Keep in mind that you can have a company that's always in need of cash, right? But they pay back because money's coming in, their inventory is being sold. They might need money for this, they might need money for that, but they're making their payments. So they're okay, right? You can never say, oh, someone's company didn't pay. No, they did pay. We talked about this question. This question is on the exam. This is your give me question where the revenue comes in and all you do is subtract the inventory and that's your earnings. Yes.
I'm so sorry. From the previous question, did you add, for the first part of the previous question, did you add just the negative? I'm so sorry. Would you be able to go back to?
This right here?
Yeah. I just want to know how you got that number again.
Okay. This and this, right? 1647, 1647, and 460 equals 2107.
Why don't
This
we
was
add
a you get it?
But why don't we add the 1,540 if we wanted to?
What 1140? We're
the
talking about here. We're talking about 2015. Right here, this part right here. That's what they're talking about.
But
Why did this turn negative?
But they said through all of 2015, no? Like,
No, right here. Took place at the end. This is the end right here. The end, right? 9/30 in 2015. Not all. I didn't say all. Took place at the end.
if it was the end, then wouldn't it only be December 31st?
No, then there's nothing going with no, not in December 31st. No. This happened right here towards the end of the quarter. Right? This came in and that's what the balance is.
Got
Okay? You Michelle, Michelle, right? That's what I'm talking to Michelle?
Yeah.
Michelle, they can't do a deal at the end and it's going to reflect. It has to be done on that last quarter where it leaves a balance for the end of the year.
Got it.
If they did it on the 31st, it'll reflect in in coming up, right? And usually, right, a company, the bank, will not put something done on the 31st because they've already closed their books. Usually. Okay?
Got it. Thank you.
All right. So as I said before, the 593, yes?
Professor, can you please show question 2D, please? Thank you.
Which one? The one I was just on again?
Yes, question 2D.
Okay.
Thank you so much. I got it. Thank you.
All right. The numbers are going to change in this because that's what my lab does. So we subtract the revenue from the inventory. And then that's all we do here. It's 189, and then we just copy these numbers from here on up. The only thing that decreases is your inventory. All right, we talked about this one. The way you calculate this is that you say 10 million. The first one, the decrease, is 10 million times 0.75, which is 750, 7.5. And the way you do the second part is negative 7.5, negative 40. Is it this right? Negative 40 and minus and plus 10 equals negative 37.5. That's what you're going to do here. And then the other side of that is negative 7.5 minus 10 million, and that equals 2.5. Now, I thought if someone asked me, why do companies do these things? Why do they always show these numbers? First of all, when you have an audit, when there's an audit, auditors come in, you have to show everything in your books. You have to explain everything. I'm not just going to tell an auditor, oh, well, we just broke down the 40 million into, don't worry about it. It's no big deal. We just broke down. You don't need to see that because it's not really, it doesn't work like that when you have an audit. Everything has to be accounted for. Everything has to be accounted for. When you're having an audit, that's what the auditors want to see. They want to see your cash flow. Then it's explained. That's how people get caught stealing. That's how companies get caught cooking their books, right? I remember there was a company out in Long Island. What they were doing was, if someone bought a house and they financed the house, they were the one that was financing the loan. Let's say it was $400,000 for the house. And the person refinanced that loan, let's say 3 years later, from the same company to get a better rate. Now, once that happens, they're supposed to remove the old loan and replace it with the new loan. They weren't doing that. They were keeping both loans on the books to make it look like it was a healthier company, that they had those types of assets, right? And they were caught and disaster, right? I also said that if Bernie Madoff had a real audit, he would have been busted on the first deal. The first deal that the auditors took and said, well, let me see this, let me follow it, they would have seen that no money ever left the bank, never left the firm. They would have seen that immediately. Right? That's what auditors do. So you have to show, you have to account for everything. You can't make $100,000 a year and have a $2 million house that you pay cash for. That just doesn't happen. Where'd you get the money from? Right? You don't have those kinds of cash stream coming in. Right? And another thing that people always have to understand, if you make $100,000 a year, if I go over to your house for, in theory, if I added up all the things you bought and the money you have in the bank after you got paid and all of that, it should all add up for that year. It should all add up to your salary. If everything is correct, everything should add up to your salary. All right, let me continue. We talked about the quick ratio. We know the formula, current asset divided by current liabilities. I believe, what is quick ratio again? It's current asset.
Minus inventory.
It's current
Minus
assets minus
inventory.
inventory over current
Divided by
liabilities.
Okay, right, okay. And that's your quick ratio. And here we see that Apple has quick ratio demonstrated, has much liquidity, it can get cash. That's another thing too, for companies that can get money. That can get money. That's a big deal. That's a big deal because things happen. Things don't always go smooth, right? Like this pandemic. How many stores have we seen go out of business? Lord & Taylor, this store, that store, this store, that store, this restaurant. Never come back, ever. Done, finish. This is just subtracting the equities, right? 22.8 minus 21.2 gives you 1.6. The market value of stock does not depend on the historical cost of the firm asset, but investors' expectation of firm's future performance. An increase book value does not necessarily increase in global share prices, and that's vice versa. There are many events that may affect global's future profitability, and hence its share price that does not show up on the balance sheet. It can have great employees, right? It can have some of the smartest people. Those things don't show up on your balance sheet. It could be a company with that passed their audit with flying colors. They follow all the rules, right? And also your market value, right? Your market value and your book value sometimes are different. You can have, like Amazon, their market value is almost at $1 trillion, but their book value is probably billions, if that much, right? And then sometimes your market value is based on future expectations, right? And we showed in the beginning of the class when we had one of our lectures, I showed you that Citibank book value and market value were equal almost. And that spells disaster, especially for a large company. And they were doing so bad that they took them off the Dow Jones average, because the stock was at single digits and there are 30 stocks on Dow. They were messing up the average. So they were removed. And at one point, it was the second largest bank in the United States, if not the world. Here, the formula is the margin that's converted into a decimal. So it's 1.107 times 30.9 divided by 109 and equals 3 times, equals 3. Round to 1 decimal. That's to cover their interest. They can do it 3 times over. That's a healthy company. Here, remember what I said. This is talking about depreciation, and depreciation is always negative. So this is for the year. 10.18 times 1 minus 0.35, right, is negative 6.62. And since you're taking your hit for 1 year of the depreciation, it will have no effect in next year's earnings. You're taking it all up front. Now on the bottom, on the second part of the question, which is question B, which is 10.20, and you're depreciating that for 5 years. It's giving you the number, and now you have the tax rate. So it's 2.104 times 1 minus 0.35. So which is 0.65. 2.04 times 0.65 equals negative 133. Class, I repeat, and I repeat, and I repeat, and I repeat. Make sure, put your little notes down that you put negative when you answer these 2 questions. This will have no effect on next year's earnings because you're taking it all in one shot. This right here, they're giving you the number. The number's here. You don't have to divide this by 5. The number's here already. They've done it for you, right? All you do is say 2.104 times 1 minus 0.35, whatever this percentage is, this tax rate. And then you put negative and you round to 2 decimal points. And it says use a negative number for a decline. It is a decline. Use negative. It's telling you. So do it. Please don't forget. And also round to 2 decimal, not 3. Don't start making up your own rules. Don't start making up your own rules. Right? Here, we say local gross margin, 10.1 minus 5.9 divided by 10.1 multiplied by 100. The second part, 10.1 minus 5.9, right? The answer you get at, you subtract 520,000, 1,200,000, and 1.5. And then you divide it by 10.1. The answer that you got from that, you times that 1 minus 0.35, that answer that you get, you divide it by 10.1 and you multiply it by 100, and you should get 6.31. Any questions, please stop me. Here, it's the same questions that we had in the other, and all you're doing here is you're multiplying price of shares time number of shares divided by uh, book equity, market to book equity, market divided by book, and you get those, and we can see that the gap has a more favorable outlook. Okay, now we're going to move on to chapter 3. Get your calculator. Yes. Someone had a question?
Can you go back to locals and co-question?
Right here?
Yes, so
Shireen?
for
Who's
this one,
speaking to me? Hi,
Shireen,
Shireen. How are you? Okay, go ahead.
so like for this question, like we have 19.5% and like 12.70%. So we don't like round it up and like make 19.5 20% and
No, it tells you right there. Round to one decimal. This
so
is
we
one
don't, we
decimal
can't
right
make
here.
it like 20.0 something, because I did that for the quiz and I got it all wrong.
Yeah, you're not supposed to.
Mm,
You're not supposed to.
okay, that was all.
So I
Okay.
have a question, Professor.
Listen to me. Let's say we got 19.56. This will be 19.6. Do you understand that? One decimal, round to one decimal as a percentage. Okay, someone else? I heard, hi Krishna. Yes, Krishna.
Yeah, just so I was just curious, like in the quiz when we solved, so we do our work, right? Can we
Yeah, what?
submit that?
I can't hear you.
Oh, can you hear me now?
Yes, go ahead.
So I was curious, like, when we do these quizzes, we also do the paperwork, like writing part and all stuff, to get this answer, right? So is there any way where we can like download the sheet so you can review our work at least and you can give us a credit if everything is wrong, you
No,
know?
no, there's nothing like, there isn't anything like that. I'm sorry. No.
Mm,
Um,
okay.
the way it works, I'm gonna be, let me explain something to you. This looks very simple because we're doing it together, right? For some of you, right? Some of you, it's gonna be a cakewalk. And when I say that, some of you have the ability to grasp this better than others. And some of you, it's gonna take a little time, but it takes a little practice to do this, right? You're not going to do this like we're doing, like it's nothing, because it requires a little thinking. And the mistakes that you're going to make, Krishna, you're going to be very upset with yourself when you see how little a mistake can happen. You're going to be very upset with yourself. A lot of you are, especially when it comes down to one decimal point, or you put an answer that you think it should be, and also not using the proper calculator, right, where the rounding is off. I had a person last semester, she did well on the quiz and stuff like that, but on the exam, she decided that she was going to put what she felt like putting, and they were wrong. The answers were wrong. And I couldn't do anything about that. I mean, okay, I can fix one. I'm not going to fix all of them. One, I said, well, I don't know, this and that, but I can't fix all of them. And I told her, and she told me, no, what she told me? She said, my calculator never failed me before. Well, guess what? All right, so we're good. Anything else before I continue?
Yeah, I have a question. Um, are we able to access the quizzes and homeworks when we're studying for the exams?
Yeah, you can. You can. There's a way
Okay,
of doing
thank
that.
you so much.
Okay. There's a way of doing that for review. And plus, Beta is Beta, right?
Yeah,
There's a way you can go back and see my recordings,
right.
right?
Okay,
You can go
perfect.
right
Thank you
back
so
and
much.
see
Yeah.
my recordings. And also, we're going to be going over it. You're going to say, oh man, again,
Can you go
we're
over
going
question 2, Professor?
yes,
Can you go over question 2?
that we just had.
Yeah, in the quiz.
I also wanted to add that there's like this study feature on Pearson where it lets you like go over similar questions too.
Right. This one right here.
Actually, no, actually it might be number 1. Can you check if it's let me see.
This right here.
No, I guess it was different for me. Hold on, give me 1 second. It's about the Apple had cash of 38.7 billion, current assets of 76.22 billion, and current liabilities of 76.9 billion. That question, what is the current ratio for Apple? What is the quick ratio for Apple?
Well, if you look at your formula sheet,
That one, yes. That one.
right? It's 76. The current Apple's current ratio is current asset divided by current liability. I don't know if you were listening to it. We've gone over this, right? Current asset divided by current liability, and I believe the quick ratio is current asset minus inventory divided by current liabilities. Am I saying it right? Right. Equals 0.97. Okay?
All right.
All right. Anybody else before I continue?
The homework what we are doing on, mm, mm, yeah, so the
Take your
quiz,
time, Krishna. Take your time. The homework, what?
the homework what we are doing and the quizzes, we cannot go back to that question and access it. Can we?
Yeah, there's a way of doing that. There's a way of doing that where you
Can
can
we?
review it.
Can you show me
Yes,
after
you can.
class or anytime, whenever?
Huh?
Can you show me? Because today I was like looking at for the revision, I was
I
looking
don't
at
remember how. Listen to me. Listen to me. I'm going to call, there's a way of doing it. And there's a way of doing it. And once you do it, you'll be able to review your work. There's a way of doing it. I'll let you know tomorrow. I'll let you know on Tuesday. Okay?
thank you,
There's
Professor.
a way of doing it. All right. Now, get
I
your
put it on the
calculator.
chat, Professor.
Huh?
I put
I
it
got
there
it,
on
thanks.
the chat.
Yeah.
Oh, you did? Oh, great. Thank you. Thank you so much. There you go. Thank you so much. Who was that? Okay, was that? Oh, thank you so much. Okay. All right. Now, let us go into homework 3. Okay? Now, this is where I'm going to be showing you how to, you need your calculators, and we're going to, can you see this? Can
Yes.
everybody see this?
Yeah.
Yes,
Okay.
Professor.
All right. Now, Honda Motor Company is considering offering a $1,900 rebate on its minivan, lowering the vehicle price from $29,000 to $2,700, right? the marketing group estimate that this rebate will increase sales over the next years from 45,600 to 55,400. Suppose that the profit margin of the rebate is 59. They want to know if this is worth doing. This is worth doing, right? So let's calculate first how much the rebate is going to cost them, right? So they lowered the price of the car. So this number, this 29 minus 27 equals 1.9, right? And then their sales is 41,600, right? That's what they usually do. So the rebate is going to cost them 1,900 times 41,600, right? And their profit margin is going to be based on the fact that they sold, right? The difference between the 41,600 and the 55,400 times this profit, right? Because of the rebate, their sales went up. Because of the rebate, their sales went up, right? So this, the net, right, 41,600 minus 55,400, you do that on your calculator, times this, that's their profit. And then what the rebate cost them was $1,900 times 41,600, right? In other words, they made less money because they gave a rebate. This is what they usually sell. So this is what the rebate costs, 41,600 times 1,900. Now their profit went up because they sold more cars. So the difference between what they usually sell and what they sold because of the rebate times the profit is how you calculate if the rebate is worth doing. So now let's look at it, right? We could see that here, right, we say 1,900 times 41,600 is 79 million. That's what the rebate is costing, right? That's the loss that they per vehicle. Now, when they turn around, they are going to check, they're going to see the benefit of the rebate. The rebate brought in less money than what it cost, right? The rebate was not profitable. The rebate was not profitable in this sense. So it does not look attractive. Now, listen to me, class, and listen to me well. This doesn't always work that way on my lab. They switch the questions around. Sometimes the rebate is profitable and sometimes it's not. Does everybody just listen to what I just said? Sometimes the rebate is profitable and sometimes it's not. Now, some of you, if you ever work for a dealership or going to work for a dealership, this is exactly what you're going to run into. I don't know if your dealership is going to sell that many cars. This might be for the company itself if you're working in the main office, right? That's what you see from total sales from the New York area for these cars, for this minivan, right? Selling 41,000 cars, right? That would be something for New York or the region around the eastern seacoast, whatever, right? That wouldn't be one dealership doing that kind of volume, right? It'd be for many and many, many, many dealerships. So this is what they came out with. Now, this does not look good. So whoever came up with this idea, right, is not going to get a good bonus that year because they failed. Another thing to understand with dealerships, right? Another thing to listen with dealerships, they only do things for 1 month, sometimes 30 days, and they go to something else, right? This will probably last 1 month. And they did not do well, so they try something else. Maybe they give more of a rebate to increase more sales. So always remember that, right? So you see the logic behind it. So the first thing we're going to calculate is the cost of the rebate, right? What it's costing us. So it's costing us this 41,600 times 1,900. And then when we want to calculate, hold on 1 second. When we want to calculate the profit, we calculate it by the amount that we usually sell and the amount that we're selling based on the rebate times the profit, trying profit margin. And we can clearly see from this right here, that the rebate was a disaster. It didn't look good. Okay? Does everybody understand?
Yeah, we understand.
Okay, I'm going to move on.
So I have a question.
Go ahead.
Yeah, Professor, you just mentioned that it might ask the Pearson will ask with the loss. Right now we are calculating based on the benefit. So how it's gonna be when if it's a loss? Can you show that also?
It depends. These numbers might be different if we go into MyLab tends to change the numbers. I don't change the numbers. So I can't do it. I can't show you. However, what I'm trying to explain to you is if this right here, the difference between the cost sales, between what usually sells and what selling because of the rebate times the profit margin, right, is not greater than the cost of the rebate is a failure. But if this was higher than the cost of the rebate, of course, we made a profit. Do you understand that?
Yes, I understand. I'll just repeat what you said. You said that
No.
the rebate is 5590 per vehicle in this scenario.
Right.
Yeah.
That's all it is. Now, if you see it again, it might not be that amount. It might be a bigger amount, right? It might be a larger amount. And then the rebate is profitable. But in this case, the rebate is not profitable, right? You're in business to make money. Okay. So this question right here is about currency conversion, right? You're working at Goldman Sachs, you're working at JP Morgan, you're working at Citibank, and someone calls you with a deal about shrimp. Now, when you're a trader, especially a commodities trader, anything can come across your desk. And I don't mean literally, I mean on the phone, right? And your job is to move these products, right, from one place to another and then make a profit. You get the shrimp, right? It's coming from another country. You don't care where it's coming from, right? And you sell it to a restaurant, a chain restaurant like Olive Garden or any place, right? You might sell it to Costco, right? Because they sell shrimp sometimes and whatever, right? So your job is immediately, if not sooner, right? As soon as you get the deal, you're trying to get rid of it because you know, and I know, if you ever watch currency conversions on Wall Street, it changes like you can't even, I can't even tell you how fast. So you're trying to lock into what they call spot, trying to lock into the deal so we can make money, right? So you're getting it from two different countries and then you're moving it, right? You are a deal maker. You are a deal mover. All of you in the class can do this, right? If you happen to work for one of these firms and you happen to be a trader, right? Or a salesperson, right? So now what you have to do is you have to convert it into US dollars, right? Currency conversion. So the first thing you do, it's currency divided by rate. That's how you get the equivalent of the dollar. Currency, so we're saying that this right here equals $1 per dollar, and this right here is per dollar. So we're going to say 2,300,000 divided by 25.23, right? And then we're going to say 3,200,000 divided by 41.22. And when you're doing these deals, it has to be done fast because the currency is losing value and it might be gaining value for the other guy on the other side of the deal or vice versa. So you want to do this as quickly as possible in real life. In real life, that's what you want to do. You don't want to do this like, you're taking your sweet time, and it has to be done really fast. Once you make the deal, you see where you are, and then you move it, and then you make your profit. And that's it. So bring out the calculator. Let's do this one together. So the cost of shrimp from the Thai supplier, which is a Thai bot, right, is 3,200,000 divided by 41.22. How much is that, class? Somebody tell me. 3,200,000. What is it?
77,632 point
77,632 point what?
point two. Oh, sorry, 0.22.
Right? Good job.
And
Next one. Let's
the
do the
next
Swedish krona. Czech krona.
for the krona, it's 91,000. I think I kind of wrote down the number.
Let's not think. We gotta be sure.
Second.
Please.
It's $91,161.32.
Okay. Now, what's the difference between both of them? What's the difference? I didn't mean to.
$13,529. And it says point, I think we should, if you're wrong enough, it would be 0.10.
The last person, the last person that was talking to me, I didn't mean that in a derogatory way. We just have to be sure. I'm sorry if I sounded a little crass. Sorry about that. All right, the last person. Yes, Sorel.
Professor, can you please explain how we come up with 77,632.22?
Yes. The Thai bot. Do you, Sorel, when you know, do you travel?
Yes, I do.
Okay, so you know how to convert currency, right?
Yeah.
So that's the same thing we're doing here, right? We got the exchange rate, which is 41.22, and then it's currency divided by exchange rate. So 3,200,000 divided by 41.22 is 76,632.22. This one is 2,300,000 divided by 25.23. That's 91,161.32. The net between the two is what we made as a profit, right? The moral behind this deal is that this happens in real life, whether it's tires, whether it's sneakers, whether it's contact lenses, whether it's shoes, ties, right? Turn off the mic, please. Whether it's coming from anything, right? You're a deal maker. You're a deal maker, right? Those things are coming across your desk. When I say coming across your desk, they come to your phone and then you move them. Now, he sold this to Costco. He sold this to Applebee or Olive Garden. So he made a profit. He locked into it right away, because if you ever notice how the currencies are changing by the seconds, you just keep moving, right? Because deals are being made, devaluations are happening back and forth, you know. So you don't want the guy that's you're doing the deal with have an advantage, and you don't want he doesn't want you to have an advantage. So you want to lock into it. Second thing that happens, right, in this situation right here, you want to get this done because you want to move to the next deal, right? You want to move to the next deal. You just, that's how you do it on a trading desk, right? You don't want any grass growing under your feet. Boom, 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 boom. Next, right? And he's doing this all day long. And the profit might not be as big, right? And there are times he might find out that he didn't make that much, or he might have lost money on one because he waited too long. The currency lost value a little bit. He could have made more money, and so on. So that's what this is. Any questions here?
Yeah, I was just wondering how you got the profit again.
You subtract 91, you subtract 76,632 from 91,161.
How does that give us profit? Sorry, I just kind of don't understand.
Michelle, he made on the check. Let me, hold on 1 second. On the check part, he made more money, right? When he converted, he got more money out of it, right? When he started, he bought it, he made more money out of it than he did than the Thai. The difference between buying the two products and when he sells them, he's going to be selling at this price. Right? He's going to be moving. He sold this to Costco and he sold this. Now he pulled it in, and then he got it, he paid for it, and then when he charged Costco 91,000. He charged this guy 77. So he had those on his books. By moving these two, This is the net number he's made.
But I thought he's giving the shrimp and getting money. So when you're saying, so when you're saying,
He's getting the shrimp. He's getting the shrimp. You're an international trader. What is he going to do with the shrimp? He gets
He's
it and he
selling
moves
it
it.
back.
Yeah, he's not going to. What is he going to do with it? What's he going to do with all the shrimp? That's the whole idea. He's selling it. That's what I'm trying to explain to you about the trading. That's the whole idea of being a trader. You get it and you move it. What's the sense of him? Why would he want to buy the shrimp and keep it? What's he going to do with it?
I'm saying it looks like he's selling the shrimp and getting money, not getting shrimp and then selling the shrimp.
They move the shrimp. I'm trying to make you understand what happens in the trading, the real thing. That's what happens. A food producer in Czech offers to pay, right? He's getting it. He's getting the shrimp, and then he's moving it. He's getting the shrimp. He's making the deal. He's the one that's doing the things, making things happen. Okay, so next question. You expect to have 1,000 in 1 year. A bank is offering you loans at 3.5% per year. How much can you borrow today? Now, what this is that you need to find the present value of $1,000 at 3.5%, right? So the way you do that, right, on your calculator, right, you're going to say N equals 1, IY equals 3.5, right? Payment is 0. Future value is 1,000, and then compute for present value. Compute for present value. And what did you come out with?
I'm sorry, can you repeat that?
966 with 18 cents.
No, it can't be 500.
966.18.
That sounds about right. Good. Now, there's another way of doing that, is this way. But we want to use the calculator, right? We want to use the calculator to avoid mistakes.
Could you
Because
go
if you-
Oh yeah,
through
that was the
what I did
formula I
on the
was
calculator
using.
again?
Huh? Oh, in the calculator? Yeah, absolutely.
Yeah,
All
do
right,
go
so-
through the steps one more time.
Yep. N equals number of periods. Number of periods equals 1 year. N equals 1. IY is the discount rate, right? IY is the discount rate. So you put 3.5 and you put IY, right? There are no payments involved right now, so payment is 0. What it's going to be worth in the future is $1,000. So $1,000 is FV, forward value or future value. And then you compute for present value. And it's going to give you 966.18, and it tells you right here, round to the nearest cent.
Thank you so much. I really appreciate it.
Okay.
Sorry, Professor, can you please say again in the calculator? I didn't get it.
Yeah, sure. N, number of periods equals 1. IY equals 3.5. Payment is 0. Okay? Future value, how much would you have in 1 year? That's in the future. Equals 1,000. And then compute for present value is 966.18. One thing I want everybody to understand, right, about this class. When I'm trying to explain something to you, right, hear me out before, hear what I'm trying to say. When you are trading, when you're a trader, right, and whether you're trading, it's like you got everybody in this class is working at Goldman Sachs, and each one of you are trading a commodity, right? And someone comes up to you with a deal for coffee, for milk, whatever it is. If you're doing the deal, you don't actually keep the product. You move the product. You don't keep the product. What are you going to do with it? What are you going to do with it? Your job is to trade and get it and move it. The minute you get it, you move it. And you can trade with another trader. He might know someone who needs what you have, and so on, right? No one keeps, those commodities, those things that are traded, they're not kept, right? What's he going to do with, can you imagine if the traders actually kept the stuff that they were trading? Where would they put it? Right? It comes over the phone and they move it. They're deal makers. Yes.
I'm extremely sorry, Professor, but I'm not getting this 966. I mean, maybe I'm not using the calculator in the right way.
I don't know. I don't understand the question.
I'm not getting 966.
Do you have the same? Do you have the calculator that we have?
Yes, right in front of me. Yes.
Okay, so let's clear it out. N equals 1. Put 1 in N.
Okay, first put 1, then N.
Right.
Okay.
And then 3.5, and then IY.
Right. Okay.
0 for payment. 0 and then payment.
Okay. Then.
And then put 1,001, 3 zeros for future value.
Okay. All right. Then.
And then compute, where it says compute.
CPT.
Compute present value.
CPT. It's on top. CPT. That's compute.
Yeah. Yeah.
Okay. So before just direct compute.
Compute and then hit present value.
Where is that present value?
It's right near future value.
It's PV.
It's
PV.
PV. Okay. I got it, Professor. Thank you.
Okay. All right. You're very welcome. All right. Now, this again is to practice on your calculation using the calculator. So we're going to calculate the future value. Class, anytime something say future value, it's always higher than the number that you're trying to calculate. And if they say present value, it's always lower. So let's do this one together. Let's do the first one. Okay? So N, number of periods, is equal to 4. IY is equal to 5. Payment is 0. Present value is 4,000. And then compute for future value. What do you get?
$4,862.03. Is that correct?
Yep. Good job. Now let's do it for the second one now. Right? N equals 8. IY is 5%. Okay? And payment is 0. Present value is 4,000. And then compute for future value.
$5,909.
$5,909.82.
Okay. 5,000.
$5,909 .82.
82 cents.
Good. Good. Last one on this one. N equals, what does it say? 4 years. N equals 4. IY equals 10. Payment is 0. Present value is 4,000. Compute for future value.
$5,856 with 40 cents.
5,856.
In a sense?
And 40 cents.
Good job. Okay. Now, this is the question. It says, why is the amount of interest earned in Part A less than the amount earned in Part B? I can't see that. You want to ask me something? Ask me. What happens is,
Oh no, Malik was just asking if when we calculate the numbers, if it's coming up as a negative figure. So I said yeah,
it
because
doesn't
that's
matter.
what's
We
coming
only
up on
deal with
mine.
absolute value in this right now. Yes, it does
Okay.
come out negative, some of them. We're dealing with absolute values. What happens is that because you earn interest on past interest, since more interest has been paid at the end of the time period than at the beginning, the money grows faster. Is that the right? Yeah, I think so. Right. So keep in mind, this is what happens. You have, hold on 1 second. Hold on. You have $1,000 in the bank, right? And it's 10% for the year. The second year, first year, you get $100 of interest, right? So now you have $1,100 in the bank. The following year, you don't get interest on 1,000. You get interest on 1,100. And so on. It's compounded. That's why the money grows faster, right? Each time you add interest on it, that's what the calculation is done on. The new amount with the new interest added, with the interest added on it. Got it? Does everybody understand what I just said?
Yeah, we understand.
Right? You have money in the bank. You have $1,000 in the bank. Year one, you get $100, right? So year two, when they make the calculation, they don't make the calculation based on 1,000. They make the calculation based on 1,100. Then you earn interest on 1,100. The following year, whatever you earn on 1,100, that's what the calculation is going to be done for that, and so on. So it's compounded. That's what that means.
So it's not linear?
What do you mean not 1 year?
So it's not linear, it's like exponential kind of?
I didn't hear you, Michelle. What? It's not 1 year? What do you mean not 1 year?
Linear, she's saying.
I'm sorry, I said linear.
Let me put up this volume. Go ahead.
No,
Say that
she's
again.
asking if it's not linear.
She's asking if it's not linear, as in it's growing at the same rate, but you're saying that it's the interest is being compounded every year because it's earning
That's right.
interest on a bigger value.
That's right. Exactly. That's what happens. That's what happens. And that's always the case when you put money in the bank. That's why you hear they say they compounded interest, right? And that's why the money grows. Because if you're just relying it on growing on the original book value, it'll never be an astronomical number like you would have in your 401k and all of those things, right? Right? You put $1,000 in the bank, and at 10%, year one, when year one is over, you get $1,100. You get $100 interest. So now you have $1,100 in the bank. Year two, when you're calculating, it calculates interest on $1,100. And let's say you got $200 now added. So now you have $1,300 in the bank. The second time, the third year, you get interest on $1,300, and so on. That's how the money's calculated. That's how money goes faster. And it tells you right here the result, because you earn interest on past interest. Since more interest has been paid at the end of the time period than at the beginning, the money grows faster. And that's the answer right here. That's exactly what I just said.
Could I ask you a question? How do you know what PMT was for A, B, and C?
What's that?
How do you know what the PMT was?
PMT? How
Yeah.
did I know what?
Yeah,
What do you mean,
what
how
the
did I
payment
know?
was. Did it say it in the question?
Which one? You confusing me now. I want to know. What are you talking about? Show me.
Let's say for question C, what did we type in for PMT?
We capped zero. Zero. Payment is zero. We're not using payment yet. Function payment is not being used yet.
Okay, fine. Okay, thank you.
Right. Payment is not being used yet. We're going to use it, but not yet.
Okay, got it. Thank you for clarifying.
Okay. Now, your cousin is currently 12 years old. She will be going to college in 6 years. Your aunt and uncle would like to have $95,000 in the savings account to fund her education at that time. If the account promises to pay a fixed rate of 4.2 per year, how much money do they need to put in the bank into the account today to ensure that they will have 95 in 6 years? So what we need to find out, we need to find the present value of 95,000 and then deposit that in the bank. And then in 6 years, we're going to have the 95,000 that they want. Got it? So the way we're going to do that, we're going to say N equals 6, IY equals 4.2, payment is 0. Payment is 0. The future value that we want is 95,000. So FV equals 95,000. And then we compute for present value. And that's what we need to put in the bank. So how much is the present value?
74,000.
74,219
219.
What's the cent?
and 37.
So that's what they need to put in the bank. That's what they need to put in the bank right now, right this second, when they're talking to whomever they're speaking to have 95,000 in 6 years at this interest rate. Okay, I'm going to stop right here. And then I will continue on Tuesday on this. We will finish up and I'll assign the homework. But believe me, everybody's going to get this. And same way I learned it, you will learn it. And just take down your notes, make sure you write things down, and you will be able to do this also. Just like you get it. You'll get it. Believe me, you'll get it. You get it. All right. So let me, without any further ado, let me just take a little attendance there. And good class. Good class.
Professor, quick question. The amount that you got just now was 74,219?
Yeah, that would be the present value, Sabrina, of 95,000. What it's saying to
Oh, okay. I just wanted, yeah.
right, what it's saying to the aunt and uncle that want to have $95,000 in 6 years. This is what you have to put in the bank right now, and in 6 years you'll have $95,000 at this percentage. That's all it's
Okay, I
saying.
just wanted to make sure because instead of using the calculator, I find it easier to just plug it in the formula. So I'm just gonna use the formula.
Whatever works for you, but make sure you know what you're doing. All right.
Yeah, I got the same answer. I just want to make sure because with this, then you have to plug in the period like 6 years, and then it would give you the present
Whatever
value.
works for you for the exam, and you're doing it, it works for you. I'm all right with that. You just have to deal with it if you get it wrong. But if it works for you, I'm fine with that. All right. I will see everyone on Tuesday. Have a great evening and be careful driving. And I'll see you guys on Thursday. All right? On Tuesday. Take care.
So Professor, just to make sure, no homework, because you still have a few more stuff to go over on Tuesday.
Right. We didn't finish. We have a lot to do.
Okay, thank you, Professor. Have a good night.
Okay.
Professor, you still there?
Yeah, I'm right here.
I sent you an email earlier. I didn't get a response, so I don't want to like discuss it in front of everybody. But if you can, check it.
Okay. All right. Let me look at the email. Don't worry. Alexis, you wanted to talk to me? Can you send me an email also? Okay. No problem.
Thanks,
Okay. All right.
Professor. Have a good
Hold on. Let me look at it, and I'll look at it. Okay. I'll get back to you.
Thank you. Thank you. Have a good night.
Don't worry. Don't worry, Alexis. We're good. Okay.
night, Professor. Thank you.
Take care, Beta. Take care. Bye-bye.